Now we're going to have a look at cyclicity next, and cyclicity is really how the markets breathe, cycle and move, and it's really useful to use that alongside your moving averages and your price action to get an idea of the whole picture of what's really going on. Now when markets are in trend, they cycle, but when they're in range or going sideways, they don't. And we need to be aware of how markets cycle and when high probability trade setups occur. So in an upward trend here now, we can see that overall in this very simple image, the market's moving up, represented by the arrow from the bottom left to the top right. Now phase 1 is moving in the direction of the overall trend, and phase 2 is moving against the direction of the trend. That's phase 1 moving in the same direction as the overall trend, and phase 2 moving against the overall trend direction. And these little circles are just highlighted at the end of those phase 1 and phase 2s. They're key turning points, or key reversal points. They're price action patterns that we're going to be looking at a little bit later on in this webinar. And in an upward trend, price will put in higher highs and higher lows. That means that looking from the very bottom of the first circle, we can see that the lows are getting higher, and we can see that the highs are getting higher. So in an upward trend, we have higher highs and we have higher lows. If we look at the chart now, for an example, we're looking at the upward trend again from before, and we're going to show the phase 1, which is going with the trend, and the phase 2, which is moving against the overall trend direction. The phase 1 that's moving with the trend, and the phase 2 that's moving against the trend. Phase 1 moving with the trend, phase 2 moving against the trend. And we can see very clearly that the phase 1s are bigger than the phase 2s. That's the reason why we're looking to buy, and we're looking to find a reason to buy when price changes from that phase 2 into that phase 1. So the phase 1 we can see there now, the phase 2, the phase 1, the phase 2, the phase 1, the phase 2, the phase 1 again. So we can see all of the phase 1s are longer than the phase 2s. We're looking to buy into this marketplace where the red arrows change into the blue arrows. Now looking at cyclicity to the downside now, we have to take a mirror image. Bearing in mind that phase 1 is with the trend. So when the market was going up beforehand, phase 1 was going up. But now the overall market direction is down, phase 1 is moving down. Because phase 1 is with the trend. And phase 2 is against the trend. That's phase 1 with the overall trend, phase 2 against the overall trend. And just as before, those circles, those price action patterns, those key turning points, are something we're going to look at a little bit later on in the webinar, and we discuss reversal bar formations in detail for you. So here we can see in the downward trend, we have lower highs and we have lower lows. LH for lower high, LL for lower low. We can see we have lower highs and lower lows, and we'll have that in a downward trend. The market's moving down. Looking at a downward trend chart example here now, we can see we've got ourselves a big phase 1 moving down, and notice that the phase 1 is moving down here, the phase 2 pulls back up again. Phase 1 is the direction of the overall trend. Phase 2 pulls back against the trend. Phase 1 with the trend, phase 2 against the trend. With the trend, against the trend, with the trend. We can see that those phase 1s are all bigger than the phase 2s, and that's the reason why we look at profit from trading the phase 1s, we don't trade the phase 2s. And we can see that these highs and lows that are being mentioned can also be referred to as swing points. But in an upward trend, we have higher highs and higher lows, and in a downward trend, lower highs and lower lows. And if we haven't got any of those combinations, Anything else is not trending. So it seems quite simple, right? So why and how do people get this wrong? Well, the first lot are the cyclicity clueless traders. Remember all those red arrows on the chart that I told you not to trade? Well, that's exactly what the cyclicity clueless traders do. They trade in the wrong phase of the cycle because they don't know about cycles, they don't know about trading phases. The second type of person that trades that gets it wrong are social proof traders. They wait for the market to start to go in the direction of the overall trend, and then wait and wait just to make sure. And then when they're finally happy it is moving in the direction of the trend, they decide it's a bit too late. And then it keeps going. And then it keeps going. And they can't bear to not be in the market. They jump in right at the end of phase 1, and it turns over into phase 2, and they lose. And that's what social proof traders do. But you guys, you'll be focusing on being profitable traders. At Learn to Trade Online, we teach people how to enter on the bounce, which is a confident and efficient entry for making consistent profits in the markets. And cycles and cyclicity is the big picture of how the market's moving and how the market's trading. You trade the bounce, you don't trade the extension. Understanding cyclicity enhances the effectiveness of all successful Forex strategies.